Very much, Jim, and thank you so much for this opportunity. And Ben, thanks for contacting New World Angels a while ago. And Norma, thank you so much for all you do as head of U of M Innovation. And shout out to current member, treasurer, director extraordinaire, Bob Williamson. And we have some alumni members. Joe Collar has been mentioned once already. He's an alumni, former director of the board. And we have one other here somewhere. Allison, who's a wonderful collaborator too. We've had the fortunate situation of having backed or co-invested on two institute companies. Wonderfully, both out of Gainesville. However, we would like to do a UM deal too, so we're going to try hard. But we did fund Paracosm and OB Medical, which both are university spinouts. So we're here because we like what comes out of Florida's universities. Norma, thank you. So I saw you, so I'm acknowledging. Great. All right, and our name is in fact New World Angels, not Angles. That's a typo that I did not discover at 4 o'clock when I left Palm Beach County. So anyway, okay, so who are angels? And let me ask quickly, how many folks here are researchers, like primary researchers within the U of M community? Okay, and how many are business people? Okay, and how many are, I guess that kind of covers it pretty much for our relevant purposes. All right, wonderful. How many are in life sciences or med device or healthcare IT? Okay, I kind of biased this presentation towards that because I kind of assume that's what the audience is, and that's some of the best technology that we've seen coming out of U of M, but we can extrapolate a little bit from that. All right, so who are angels? Angels are individuals that invest their money. We're not professional per se, investing institutions, as my colleague who will follow me is. He actually invests money for professionally, day in, day out, but they're primarily investing their own money, somewhat as a hobby, but also trying to invest roughly 10% of their investable assets to just get some diversification. But as I mentioned before, as I mentioned here, that they're motivated by non-financial factors as well. It's an asset class that allows angels, many of them are retired or some are just recycled entrepreneurs, successful prior entrepreneurs that really like to get their hands dirty in investments, meaning they like to study, they like to work with the teams, they like to help shape the companies in ways that investing in publicly traded stocks don't allow you to do. It's a very unique asset class, very high risk. Most angels know that if they make 10 investments, 6 will expire worthless within 3 to 5 years. Investments 7 through 9 might return half their money, maybe 3 times their money, but that's not why they're in it. They're in it for that 10th investment, which hopefully will return anywhere from 10 to 30 times their money and make up returns for the entire portfolio. This is a very high-risk game, and so a good angel understands risk, knows how to price it, embraces it, and likes to work with entrepreneurs that are also comfortable with risk and similarly situated, understand what it might take to build a successful commercial enterprise. And angels are very social in what they do, meaning there's not a lot of information posted on how do you build a company successfully in this space, what are the company's challenges and all that. They have to often do that research on their own. They have to do it with or in collaboration with other angels. So angels are constantly looking for resources. If you do end up working with angel investors, they'll want to do due diligence with you. They want to share what they found. They want to talk with other successful investors, researchers, et cetera, in this space to try to assess the various qualities of dimensions of risk and ultimately price it and then invest in that risk. So there's different types of angels, and this is very relevant for those of you that are just starting out or until you're successful enough that you can actually secure venture capital from an institution. And there's individuals, there's small bands of individuals that work together. Usually your high net worth folks, your retired corporate executives, et cetera, will kind of invest kind of in small groups. Then there's structured angel groups. I welcome you to visit the Angel Capital Association website. I think also the Institute probably has some resources to help you find angel groups or angels as well. But these are subsets, individuals groups, structured groups. And structured groups, there's many different flavors. But if you go to the website, you can gain some education on how structured groups work. Then there are dedicated angel funds, which are somewhat like venture capital funds, but different in terms of their incentives, their governance, and kind of how they operate in general. And then there's crowdfunding sites. There's a lot of innovation right now in the earliest stages of what we call high-risk investing or angel investing. A lot of innovation, and the jury is still out on a lot of it. And it's kind of exciting to see the landscape kind of build out. Crowdfunding. I just came from the Angel Capital Association meeting out in San Diego about a month ago. I would say probably a third of the seminars were focused upon crowdfunding and how to work with it, and should you work with it, and what's the future of it, et cetera. We don't yet know. The regulations aren't yet formalized, so it's something that bears monitoring, but know that it's out there and study it as you kind of figure out this whole landscape. Again, this would be a day-long seminar to kind of discuss each of them, but I just want to let you know they're out there, and hopefully you'll get a copy of these slides, and you can then follow up and learn, and I'm happy to, if you have any questions afterwards, and also the Institute, again, is a great resource for this. Okay, so just to drill down a little bit further on a group like New World Angels. New World Angels is very emblematic and symbolic of what a structured angel group is. We are 56 accredited investors. We live in 9 counties throughout the state of Florida. The highest concentration is the Tri-County area here. Everyone is an investor. We work as a collaborative group. So that individuals don't have a veto right, they can't opt out of a deal. That the understanding is that everybody does the due diligence as a group, as a team, and they raise their objections loudly and forcefully, but everyone works together, and ultimately we have an investment committee of 12 that is kind of like a safety like a ceiling there and a safety gap, or safety valve, which says that to kind of study and validate the diligence that the group has done. And if the deal then passes muster with the investment committee, then every member is on the hook for not less than $10,000. So 56 members times 10,000, out the gate we're good for $500,000. Frequently, if deals are very popular, members will invest even more than just the $10,000 minimum, and we can get, recently we hit $1.6 million internally in a medical device company. And we can do financing rounds much greater than that in matching with grants from or equity with groups like the Institute, and also other angel groups throughout the region. We have co-invested with a recent deal. We co-invested with 5 other angel groups, and there's a lot of sharing, not only of money but also of knowledge. We can help. Once we've done some diligence, we can also share that due diligence with your permission with other investors. Getting the backing of an angel group is very helpful because it does validate, not necessarily the science, because we're not necessarily qualified to validate that, but the company's governance structures, the valuation, which we study and make an argument for, and that the company is actually ready to be invested in. So this slide here just kind of speaks to why angel groups join structured angel groups, because a lot of this, some of it we pay for on a kind of an outsourced basis, some of which we have very defined structures and processes to help us look at as many deals as possible in an intelligent way as possible. We'll get anywhere from 15 to, say, 30 business plans in a month. And we ought to try to do the best job we can on a monthly basis, given that we're not professional investors, not doing this full time, to kind of quickly assess whether or not it's something that we would like. And for those deals that we pass on or reject, it's not that we're saying no one would find it interesting. It's just that given the composition and the profile of our particular membership base, it probably wouldn't be a good fit for us, and that we don't want to waste company's time or waste our time. But I would ask, if you apply to any angel group or any individual angel, just understand that it's a very highly subjective activity, angel investing. And so it doesn't mean that, rejection doesn't mean that they think that you'll have no chance of success, just that there's not, that particular match doesn't have a high probability of being consummated. So here's a bit of our history. We've done 15 investments, 11 follow-on rounds. We've had 2 exits. And 3 flameouts. The rest are either we're hoping, we're praying, we believe they're going to do well, or they're what we call zombies or Walking Dead. Somehow they keep raising money and stay alive and refuse to die. And we don't want any company to die, but of course we're rooting for the ones that are showing some promise. And so you see a sector here. We have made 2 bets in biotech, 2 in device, 2 in healthcare IT, and then the rest are different areas there. And this is important for angels. They want a diversified portfolio. So we try not to be too highly concentrated. But I will say we're one of the few angel groups that does take a big high risk bet on biotech and med device. There are many groups that won't do it for reasons that we'll hopefully have time to discuss later. It's even harder. If starting an early stage technology based company is difficult, doing it in the life sciences is even more challenging for, again, reasons we can hopefully get to. So here's a synopsis of those 5 companies drilling down, and there's BioHeart, and Joe Collard was one of the kind of key investors there back when we did that deal back in 2005. Altor, Consulta Doctor, and these were our 2 exits, Consulta Doctor, Bioceptive, and OB Medical more recently. These are our 2 device companies, and we're happy to say that within the past 2 months they both got FDA approval for their technology, so that's very exciting, and we're very hopeful. This was an institute company, OB Medical, and the other one is not life sciences, Paracosm. All right. So is this the time to do this? The keys or?
No, we'll come back and talk about it in a general forum. If you want to
Okay.
touch on it, go ahead.
Well, just just because I think it's helpful. So, what kind of rings the bell of an angel investor? Because we do get a lot of plans. Because life sciences, med device, et cetera, is very, very, very challenging as an investor from an investment perspective. Something that's meaningfully differentiated. You want to really show, hey, this is special, this is unique. And then the team is really, really key. Allison made mention before of the jockey betting the jockey. And that is so true when you're kind of pre-formation, and it's absolutely all you have when you're first forming the company. How we perceive the jockey shifts slightly once you're ready to go, once you're ready to raise capital, because you will need a business leader. You'll need a full-time manager, or at least a manager that's ready to be full-time once you're funded. So we look at the jockey, then we're kind of looking at two jockeys, not just the scientific co-founder, but we're really looking at that business manager. Do they have relevant experience from industry, if at all possible? If not, then do they have great success in their chosen field, et cetera? Sometimes we know it's very hard. You can't always get exactly who you want, but it's really, really key. If you could find managers, business folks with successful track records with a relevant set of experience, and that's really the home run. And then if you don't have it, you get a lot of credit as an entrepreneur and as a scientific co-founder for showing your math, showing your thought process. We know we have a gap. We're not trying to fool you or cover it up. We know we have a gap in sales and marketing, and we know we don't know that. Here's how we're going to compensate for it. We're hiring this consultant, or we've brought this person on our advisory board who has an amazing experience, and they're really committed to helping us figure it out. And at the appropriate time in our development, we'll bring a person like them full time. But if you can show that you understand that this is really important, that the sales and marketing plan is almost every bit as important as, let's say, your financing plan or your intellectual property estate, things like that. We talked about intellectual property. That's particularly true in life sciences and med device. Very, very important. And if you can't get it, there might be other defensible barriers to entry. You might get an exclusive distribution contract with somebody, or you might get the key thought leader in an entire area, or in your chosen area that no one else could ever. If you have an exclusive engagement with him or her, that's a key thing. That's a barrier that no one else can kind of surmount. I cannot emphasize enough how important low valuation is. It makes up for a lot of sins. I've seen deals before where maybe you're not thrilled with the technology, it's competitive positioning, or maybe the manager that you've partnered with doesn't really have direct relevant experience, but wow, what a deal. The valuation's good. And it kind of allows us to suspend our disbelief when we assess risk. But unfortunately, we don't see that a lot of times, particularly coming out of universities. There's kind of an inflated belief in what the valuation should be, at least from our perspective. And so there's a Venus and Mars issue there. But I would encourage you to think very highly about figuring out what is the market valuation and then try to undershoot it a little bit. It's the same with you can't sell your house after a year. Why is that? Lower the price, boom, you got three people calling you already. There is a market out there for this. You don't see it, you don't live in it. Folks like myself, Allison, and forgive me, he's brand new to Miami and I forgot your name. We live, eat, and breathe this. So there's a market, and we know a good valuation when we hear it and see it and feel it, and it's really important to us. It's an important signal. So I would encourage you to kind of do your homework on that. Governance provisions, no time, but good attorney, good term sheet will show that we're speaking the same language, that you take shareholder protection seriously, and that you're not going to run the company like you run your private lab, because those are two different things. You cannot do that. All right, nice luxuries. We'll talk about this later. I'll save this, but will I have an opportunity to answer? Okay, great. These are the things, boy, wish you could have, but we understand it's not reality in life sciences. So,
thanks, Rhys.
Thank you.